All right, now let's look at a 15-year mortgage. And we're going to use the same numbers: $200,000, $40,000 down payment of 20%, 15 years, again, using 4% as an interest rate. Your payments is a little bit more, right? So your payment plus interest plus property tax and homeowners insurance is about $1,381. We actually blow that on a monthly basis. But here's what you need to understand. And here's why it makes so much more sense, definitely for property, is you don't want to be in property long because the amortization schedule does not benefit you. And let me explain to you what I was saying. Even when we looked at the last one, we looked at a 30-year, which is more expensive. I'll cover that in another video and show you the true numbers behind that. But let's look at the numbers and see what it tells us about just looking at the two as we look at them and comparably. What we're going to see here is the last schedule that I showed you for the 30-year. You saw that the interest rode along the top. That was the pink indicator. The interest rode along the top. Here, the principal rides along the top. Okay, the principal rides along the top, right? And the break even here is 2028. And the last break even on the 30-year, go back and look at it, was 2040, right? And here's why that's significant. Because more is going towards your principal, right, than it is going towards your interest. You're paying more. They're rewarding you more for paying your interest. And here's the reason why. The bank is taking less risk on you for 15 years versus a 30-year. It just does not make sense for you to do that. Also, what you'll notice is the last loan, if you go back and look at it, of the 30-year, the payoff was 2050, right? It was a 30-year. You get a 30-year in 2020, 30 years later, 2050. This particular payoff is in 2035. The actual break even on the 30-year was 2040. So it was 5 years. You would have been breaking even on that mortgage and having it favor you with the interest going towards, you'd have been gaining more principal going towards the loan. That was not going to happen until about 2040. You'd had this loan paid off in 5 years prior to that even happening on a 30-year. Makes so much more sense. Even when you think about how much they would even charge you up front to get a 30-year. I'm telling you, lenders are catching on, and it does not make sense for them to do 30-year mortgages anymore. They're going to really probably make it more difficult for you to do a 30-year because it just takes too much more risk. I did a video and did some training on why it makes sense to do a 15-year versus a 30-year, because there's no employer going to guarantee you income for 30 years.
With a wonderful presentation of financial literacy from Jenny Jones. Over my shoulder here, you see terms that I wasn't aware of when I was 9 years old. Balance sheet, understanding liabilities, understanding assets. Jenny Jones, we appreciate you. We appreciate the message you bring and your investment in our youth. Thank you.